Good evening, guys. A very warm good evening to everyone. So let's wait. Let's wait so that others can join as well. Once we are a good strength to start with, we will start. Good evening, guys. Very good evening. Let's wait for a couple of more minutes so that others can join as well, and then we'll start. Yesterday, I shared the Excel sheet, right, Akshay? By the end of the class, I'll share it again for you if you want. So I have shared the Excel sheet in the chat box to have a look at it. Can you please share the sheet? Yes, I have shared the sheet in the chat box. Have you guys received it? It won't, yes, the sheet, if you have been connected through mobile, you won't be able to see that sheet. So if you are connected through mobile, you won't be able to see that sheet. Okay, let's start. Let's start. Let's start from where we left off yesterday. That is cash conversion cycle. Now, let's say we are on, it will be uploaded on LMS by tomorrow. SK. It will be uploaded on LMS by tomorrow. Let's say it's 1st June, and on 1st June, you placed an order for raw material. Place the order for raw material. Whom will you place the order for the raw material? To your suppliers. On 15th June, you release the payment to your suppliers. Payments released to the suppliers. On 30th June, you have made the sales. It means that you have sold the product. And on 15th July, you received the payment. From that is tomorrow. Received the payment. Now, please understand the chronology. On 1st June, I placed the order. 15th June, I released the payments to my suppliers. 30th June, I made the sales. And on 15th June, I received the payment from my customers. Now, I want to find three important things. What are these important things? First, the period for which inventory was in my godown. Or warehouse. The period for which I had hold the inventory. I am writing hold. The period for which inventory was in my hold. That period is from 1st June to 30th June. Am I correct? Are you there with me till here? Today's topic we have started with the yesterday's class, that is cash conversion cycle. And today we will be completing with ratio analysis and try to forecast future use of financial statements. There with me, guys. We have starting from 1st June to 30th June. This is the period for which I have inventory under my control. Does anyone have any doubt till here? Please stop me here itself. Otherwise, once I move forward, I won't be able to come back and discuss this because this is going to be a fairly long topic. I tried to cover it in short span yesterday, but some of you were not able to understand it. So that is why I am trying to stretch it. Good to go? Fair enough. So PT, we have just discussed what we discussed yesterday at the end of the class. This is the timeline where on the 15th June, on the 1st June, I have placed the order. On 15th June, I have released the payment to the suppliers. On 30th June, I have sold the product, and on 15th July, I have received the payment from my customers. So what is the period for which inventory was in my control? The period for which inventory was in my control was these 30 days. And this 30 days would be called days of inventory on hand. This is the period for which inventory was in my hands. By me, I mean the business. This was the period for which the inventory was in my hands. Yes, if you have tablet, you can use a tablet for this. Next. Now, for how many days you gave credit to your customers? For how many days you gave credit to your customers? You sold the product on 30th June. Guys, am I audible clearly? We sold the product on 30th June and we received the payment on 15th July. So for these 15 days, I had given credit to my customers. So for these 15 days, I had my receivable standing. I wanted to receive this payment, and this payment I received after 15 days. So this is my days of receivable. Days of receivable. Days of receivable outstanding. For how much time the file that I shared today was, I will share it again. That was shared in the last class as well. Some people didn't have the access to it. That's why I shared it again, Nikamni. So I'll share it again when I'll start with my Excel part. Don't worry. Try to focus over here. And please make sure from the next class you join on time because you have missed quite a bit from there in the last 10 minutes. No worries. So what I was saying is we have days of inventory on hand. We have days of receivable on hand. Now, what is the period for which my suppliers gave me credit? What is the period for which my suppliers gave me credit? So I had purchased product over here and after 15 days on 15th June, I am paying them back. So for this 15 days, I was payable to him. For these 15 days, a payable was outstanding to him. I was payable to my suppliers. So this is days of payable. Now, if you see for how many days do I need to invest my own cash into the business? I want to evaluate for how many days do I need to invest my own cash into this business. So that is the period that I want to evaluate is this timeline. Here I made payment to my supplier and here I received payment from my customer. This is the period it takes for me to complete one cash conversion cycle. So this is called CCC, cash conversion cycle. Why? Because here I made the payment and from this day to this day, I have to invest my own cash into this business. That is cash conversion cycle. Now, to get this line, can I write DIO plus DRO? DRO plus DIO minus DPO because that would be this part. This would be the required part that I want. And can I formulate it as cash conversion cycle is equals to DIO plus days of inventory on hand plus days of receivable on hand minus days of payable on hand. Can I do this? This is basically what cash conversion cycle is. And this is what we implemented in Excel yesterday. So guys, are you comfortable with cash conversion cycle? Okay. Perfect. Yes. Which part, AM? Which part do you want me to explain again? Because I asked in midway that whether you guys have understood it, I won't be able to come back. Yesterday, connection broken in between. But yeah, everything that we covered yesterday in the cash conversion cycle, we have covered today as well. So from where do you want me to explain again? From starting. AM, I'm really sorry, but you will have to raise a ticket about it. Because in midway as well, I have asked multiple times that if you have any doubt, you can ask me because from last 15 minutes, I am explaining this. It won't be possible me to cover everything in that I have covered in last 15 minutes. You will have to raise a ticket about it. You connected just now, so you were late. I'm sorry about it, but try to go through the recordings. If you have not understood, please make sure that you raise a ticket about it. Now, days of inventory on hand, days of inventory on hand, days of receivable on hand, and then days of payables on hand. So AM, I'm just summarizing it up, but paid on 15th June. We placed another order on 15th June and paid on 15th June and sell it after 15th July. So this is average time of cycle that is being considered. So this, all these days of payable on hand, days of inventory on hand, days of receivable on hand is not directly taken from the journal entries or dates. This was just to make you understand. These values are coming from receivable turnover ratio, payable turnover ratio, and inventory turnover ratio. So the average is considered. We know that for every business, buying and selling keeps on happening each and every day. So this timeline cannot be made for every transaction, right? And this is not based on journal entry. This is based on the ratios, the respective receivable turnover ratio, inventory turnover ratio, and payable turnover ratio. AM for you, I am summarizing this up. Please try to understand if I'm making a valid point over here or not. Are you there, AM? Shall I start? Perfect. Mridula, I am getting responses from people. So probably Mridula, there might be an issue from your end. So please try to reconnect. So what happened on 1st June? On 1st June, I placed the order for raw materials. And on 15th June, I released that payment for raw materials. On 30th June, I made the sales for those raw materials. And on 15th July, I received the payments from my customers. This is the timeline. This is how the chronology flows, correct? I have mentioned the short forms that I have used over here. RTO is receivable. I will write that as well. Just give me time. So AM, are you getting this? Place the order, payment received, made the sale, payment, sorry, place the order, payment released, made the sale, payment received. This is the chronology. Now the time for which my supplier gave me credit was the days of payable on hand because I had to pay him in these days. The time for which my supplier gave me credit is days of payable on hand. Clear with this? This is DPO, days of payable on hand. The time for which inventory I had hold the inventory, the time for which I had hold the inventory is DIO, days of inventory on hand. And days for which I had given credit to my customers is days of receivable on hand, days of payable on hand, days of receivable on hand, and days of inventory on hand. Are you clear with these three parts? AM. Now we need to find what is the period for which I had invested my own cash. Out of this whole period of 45 days, do I need to invest cash for 45 days? The answer is no. Because for first 15 days, my supplier is funding me. My supplier is funding me through days of payable. So I just need to have cash for the rest 30 days to run my business. And that is my cash conversion cycle. So out of all these 45 days, this part is funded by my supplier and this part should be funded by me. Okay, fair enough. AM, AM, is it good? Shall we go ahead? Perfect. Now let me share the sheet. Someone was asking me to share the sheet again. Please see the sheet. I have shared it in the chat box again. So this was cash conversion cycle. What was this? This was cash conversion cycle that we formulated yesterday. Sheet is not visible, guys. Is the sheet visible to you? Please confirm. Sheet is visible to rest of the people. Arpita, I would want you to have a look at it again or try reconnecting it. Probably there might be a network glitch from your end as well. Now, please tell me about the three ratios that you told. So the three ratios that I told was receivable days, inventory days, and payable days. Days of receivable on hand, days of inventory on hand, and days of payable on hand. Okay. Sheet is not showing Excel to open. Sheet is not showing Excel to open. I'm not getting what you're trying to say. Sheet is not showing Excel to open. What does that mean? So the people who might have joined through mobile won't be able to see the sheet in the chat box. People, those who have might have joined from mobile, might not be able to see the sheet in the chat box. It will be uploaded on LMS. So you can go for viewing the lecture for now. Now we are done with cash conversion cycle. It will be in the download folders as confirmed by RN. Okay. Now we want to start with solvency ratios. What do we need to start with? Solvency ratios. What are solvency ratios? Solvency ratios helps us to measure the long run sustainability of the company. Long run sustainability of the company. Whether the company will be able to survive in long run or not, that is what given by solvency ratios. Now, what are the ratios covered under solvency ratios? Debt to asset ratio, debt to capital ratio, debt to equity ratio, leverage ratio, for that RT, please raise a ticket and get in touch with the team. I won't, the schedules are not in my hand, right? So I won't be the best person, like how many exact classes will be remaining. And finally, the interest coverage ratio. Now, debt to asset ratio. Starting with debt to asset ratio, the name itself will confirm you what you have to put. It's total debt upon total assets. So is equals to, we will go with borrowings, debt divided by total assets. Debt divided by total assets. This will also be in times. So I will copy this format, Control C, and I will put this format. Debt to asset ratio, debt to capital ratio. It approximately takes 6 months to complete the whole session, the curriculum part. Now, RT, I would please request you to let me focus on the teaching part of it. Let's not deviate the class for now. If you have any doubt, you can raise a ticket about it. We can connect one-to-one and address your concern. Debt to capital, debt, that is borrowings, divided by total capital. Now, what is total capital? Total capital is equals to borrowings, debt plus equity, and reserves are part of equity, so we will include reserves as well. Debt to total capital. Okay. Next is debt to equity ratio. So borrowings divided by, I'll repeat, let me just complete the set and then I'll repeat it again. Debt, borrowings are our debt, divided by, always remember to open bracket in denominator. Yes, I have rounded off the values. Always remember to open bracket in the denominator while adding or subtracting. Equity share capital plus reserves. This is debt to equity ratio. What is leverage ratio? Every other term itself says you what you need to do. So in debt to asset, you will be doing total debt divided by total asset. In debt to capital, you will be doing total debt divided by total capital. In debt to equity, you will be doing debt divided by equity. In debt to capital, if you are getting confused, what is total capital? Total capital is nothing but debt plus equity. So this is what we will be doing. Borrowings are represented by debt divided by bracket open. Equity plus reserves plus borrowings becomes my total capital. That is debt to capital ratio. Next one is leverage ratio. I'm making a note for leverage ratio. It is asset, that is total asset divided by equity. Asset divided by equity. Now, how will we formulate this? These are my total assets for the given year divided by bracket open equity. And finally, interest coverage ratio, that is EBIT upon interest expense. EBIT divided by interest expense. Now, if this is 23 times, it means that my operating income is sufficient to cover 23 times or approximately 24 times over here, 24 times of the interest that company pays. So company does not has a very high pressure for paying the debt holders. The company can plan their debt in ease. Leverage ratio, the leverage formula for leverage ratio is asset divided by total equity. And in total equity, we have considered reserves and equity share capital. Asset divided by total equity. Assets divided by total equity. I am coming to leverage ratio. Yes, I have made the note of formula. Interest coverage ratio, EBIT divided by interest expense. Next, what is leverage ratio? Why the name leverage? Leverage means taking risk. In finance, leverage means taking risk. When you take higher debt and lower equity, you take more risk. When you take higher debt and lower equity, PP probably a calculation error. We will come to it. Let me just complete the explanation part. 1.3799. Let's see why is that difference coming, PP. But let me cover the explanation part, then I'll address your concern that why the values might not have been getting matched. Make sure you have selected the values for 2015 meanwhile. See, debt to asset, debt to capital, and debt to equity is very simple. Numerator will be debt, that is borrowings, and denominator will be asset, capital, and equity. Now, what is capital? Capital is, when I want to calculate capital, I will choose these three: equity, reserves, and borrowings. If I want to choose only debt, I will go with borrowings. If I want to choose only equity, I will choose equity and reserves. If I want to go with assets, I will use total assets. That is all about debt to asset ratio, debt to capital ratio, and debt to equity ratio. Coming to leverage ratio, what is the interpretation for leverage ratio? If let's say a leverage ratio is 24 times over here, what does that mean? It would mean that my operating profit is sufficient enough to cover operating profit is sufficient enough to cover 24 times of interest expense. What would that mean? That we have generated enough income so that we pay 24 times of the interest what we are paying now. So we don't have pressure of debt holders. We are not, as a company, we are not under the pressure of paying back the debt holders. And how are we going to pay the interest cost? It means we are safe to operate in long run. This is what interest coverage ratio says. Now, leverage ratio measures the risk of the company. Riskiness of the company. For example, let's say there is a person A who has equity contribution of 1000 rupees and has taken assets worth 10,000 rupees. Where is the rest of the amount funded from? Where is the rest of the amount funded from? The rest of the amount is funded from debt. So 10,000 minus 1,000 is 9,000. 10,000 minus 1,000 is 9,000. On the other hand, there is a person B. On the other hand, there is a person B who has contributed equity of 5,000 and taken debt of 1,000 and have assets worth 6,000. Or let's say he has taken equity of 9,000 and assets are worth 10,000. And this minus this, the remaining portion is being funded by debt. Okay, now tell me, why do we consider EBIT for interest coverage ratio and not PAT? I'll come to that as well. Good question. Why do we consider EBIT for interest coverage ratio and not PAT? Now, please focus over here. Who is more likely? Who has taken more risk? Who is more likely to get bankrupt? Which person is going more likely to go bankrupt? He has spent 10,000 on assets and he has contributed 1,000 from his own pocket. 9,000 is taken by debt. Here, he has just taken 1,000 rupees debt and contributed 9,000 from his own pocket, and his total assets is 10,000. Obviously, B is always in a better position than A. A is more likely to go bankrupt over here. So that this is how we measure leverage ratio. Leverage ratio is assets taken as a times of equity. Let's suppose I have contributed equity 1 rupees and my assets are 15 rupees. It means my leverage ratio would be 15 times. It would mean my leverage ratio is 15 times. It means that 1 rupees I have contributed from my own pocket and 15 rupees worth of assets I have taken. I have taken 15 times leverage, 15 times debt, 15 times leverage, 15 times risk of what I have contributed, not debt, but risk. 15 times of risk of what I have contributed from my own pocket, highly leveraged. On the other hand, if let's say, consider over here 1.41. 1.41 is the amount of my assets and 1 rupees I have contributed from my own pocket. It means that I have taken risk worth 1.41 times more of what I have contributed in equity. Leverage ratio tells us how much we have total assets and how much we take from outside and my pocket. You can interpret it in that way. But what leverage ratio tells you is how much times of risk you have taken of the amount that you have contributed. So if leverage ratio is 5, you have contributed 1 rupees and the risk you have taken is worth 5 rupees. If leverage ratio is 10, you have contributed 1 rupees from your own pocket and the risk that you have taken is worth 10-fold. Okay, I hope this is clear. Is this clear, guys? The leverage ratio part? Perfect. I'm deleting this, waiting for more. Fair enough. A higher leverage ratio will signifies the company is more risky. So higher the leverage ratio, higher the risk. AM, don't get confused. It is simply the measure of risk. If leverage ratio is increasing, company is becoming more riskier. If leverage ratio is decreasing, company is becoming less riskier. That's all. This time was the simple explanation. Are you guys comfortable with it? Are you guys comfortable with this? Shall we start? I'm dragging the formula. Next is, this is solvency ratios. When solvency ratios are used to check the long run sustainability of the company. Next, we will go for valuation ratios. Yes, PM. PM asked a good doubt that why is uh, which one did you interest coverage ratio? Yes. Why is interest coverage ratio calculated on PAT? Sorry, calculated on EBIT and not on PAT. When you generate earnings, PM, when you generate earnings, based on that earnings, you pay interest, right? So these earnings belongs to both equity and debt holders. These earnings belongs to both equity and debt holders. So if I say 5193.80 is what I have earned. If I want, I could pay 5193.80 all as my interest expense. Am I allowed to do it? Am I allowed to do it, PM? EBIT. This was the amount 5193.80. This was my EBIT. I can take a huge amount of debt and I can pay all of these, taking a hypothetical example, all of these profit that I have generated as an interest expense. I can pay that. EBIT, once EBIT is calculated, after that we deduct interest expense and come to PAT. Now 3790.60 is my PAT amount, profit after tax. Can I say that this is the maximum amount I can take debt for? The answer is no. Why? Because the maximum amount that I can take debt for is 5193.80. The maximum amount I can take debt for is 5193.80. 3790.60 is after paying taxes, and after paying interest as well. If let's suppose, ignore interest expense for a while. Let's suppose if I had paid 5193.80 as interest expense, do I need to pay any tax? Will I be need to pay any tax? The answer is no, because why? EBIT minus interest would be zero, and since I have not made any profit, I will not have to pay any tax. So based on that, the maximum amount, where interest coverage ratios try to calculate how many times of interest we can pay of the current interest expense what we are paying. So EBIT reflects that figure in the best manner. That is why we use EBIT and we don't use PAT. Equity. Okay. Explaining again. What is the interpretation of interest coverage ratio? EBIT upon interest. How much times of interest is my EBIT sufficient enough to pay. Now consider this, PM. Consider this. Let's suppose, PM, that you have, before paying any interest, you have generated 100 rupees as earnings. So your EBIT is 100. Let's say before paying any interest, PM, your EBIT, earning before interest and taxes, is 100 rupees. So if I want to evaluate that what is the maximum interest you can give me, will I consider the EBIT amount or will I consider the PAT amount? What I want to consider, what is the maximum interest PM can pay me? Let's suppose you pay 40 rupees as interest to me and 60 rupees you are remaining with. So that 60 rupees is your maximum capability of paying interest, or that 100 rupees was your maximum capacity of paying interest? What was your maximum capacity of paying interest? 100, right? So what is that 100? 100 is the EBIT amount. The EBIT gives you the perfect value that what is the maximum capacity a firm can pay as an interest. That is why in interest coverage ratio, we use EBIT. Am I clear this time? Sure, you can raise a ticket about it. But always think from that point of view. Profit after tax is calculated after paying taxes to government. If beforehand I have paid interest, I don't have to pay taxes to the government. So PAT is after tax. PAT is profit after tax. So once you have paid taxes to the government, how can your interest generating capability can be judged through PAT? That is what I meant it over here. Still, if you are confused, you can raise a ticket about it. Someone asked me about leverage ratio. Yes, K, I'm coming to your doubt. Leverage ratio, you did not include borrowings when take total equity. Why? First and the most simple reason is the formula for leverage ratio is asset upon equity. Why the formula is asset upon equity? And even though I have not included borrowings over here, it has incorporated the part of borrowing. How? Because let's say my asset is 15 rupees and my equity is 1 rupees. Let's say my asset is 15 rupees and my equity is 1 rupee. So where that 14 rupees is coming from, the extra 14 rupees is coming from where? That is debt, because there are only two sources of capital, debt and equity. So that is why it is explicitly mentioned in the leverage ratio. The interpretation is explicitly mentioned, but implicitly we don't include debt in the formula. Okay. Comfortable, K? What I'm saying is, let's suppose you have purchased assets worth rupees 5 and you have contributed 1 rupees from your own pocket. Now, how much debt you had taken? 4 rupees. How did we only know that what asset you have, what you contributed from my own pocket. Still, you were able to come to that 4 rupees of debt. How? With a logic that the rest of the residual of the capital, the extra leverage, the extra risk that has been taken is funded by debt. That is the interpretation. This is how you came up with that 4 rupees, correct? Such interpretation you need to apply over here as well. Although it is only asset upon equity, debt is explicitly mentioned. Debt is explicitly mentioned. So if asset is 5 rupees, equity is 1 rupees, the residual amount is being contributed by debt. That is the formula for leverage ratio, and that is why it does not include debt. Debt and equity will also tell me the same thing as leverage ratio. All these ratios are used to check the long-term solvency of the company, whether in long term the company will be able to sustain itself or not. Debt to equity says that 100 rupees I have contributed as 100 rupees I have contributed from my own pocket, 50 rupees I have taken as debt. So my debt to equity will be 0.5. It means that 50% of what I have contributed from my own pocket, I have taken debt. The lower the debt to equity ratio of the company is, the higher the company is able to sustain itself in the long run. Obviously, right? When you are burden free from the loan, you are expected to move hassle free in coming time. leverage is a double-edged sword. It can maximize your return, it can minimize your return, and it can maximize your losses as well. So that is why lower the debt, lower the risk of the company. Fair enough. Let's start with solvency ratios. Sorry, valuation ratios. First valuation ratio is market capitalization. Market cap. Now, what is market cap? Let's suppose if you want to buy all the shares of the company, all the shares of the company, this is the amount you will need to spend to buy all the shares of the company, all the shares of the company. Cash flow per share. It is cash flow available, net cash flow available to one single shareholder. Net cash flow available to one single shareholder. Next, EBITDA per share, earning before interest, taxes, depreciation, and amortization available to per shareholder. EBITDA available to per shareholder of the company. Dividend per share. Do I need to write after every per share that particular element belongs to the per shareholder of the company? Now you will be able to make this sense, right? Dividend per share, earnings per share, book value per share, price to earnings ratio or PE multiple, price to cash flow ratio, price to sales ratio, price to book value ratio, dividend payout ratio, now I will mention over here, percentage of net income distributed as dividends. This is what dividend payout ratio says me. Retention ratio, percentage of net income company retained through retained earnings. And finally, sustainable growth rate. long term growth rate for the company. Long term growth rate for the company. So let's start with the simple one, market capitalization. If one share is worth 10 rupees and the company has 10 shares, what is the amount that you will require to buy out the whole company? If one share is worth 10 rupees and the company has 10 shares, what will be the amount that you will be required to buy out the whole company? 100 rupees. So what is the formula? The formula will be price of the company multiplied by number of shares. Per share price of the company multiplied by number of shares. These values are in crores. These values are in crores. Okay. Again, data sheet. Number of shares, equity shares in crores multiplied by price. That is market capitalization. Okay, you guys are writing. Take your time. Take your time. Write it down. Okay. Cash flow per share. Cash flow per share. Cash flow from operating activities divided by number of shares. Okay. EBITDA per share. EBITDA divided by number of shares. Dividend per share. Dividend amount. These are annual, right? Yes. Dividend amount divided by number of shares. So everything per share, that particular element will be divided by number of share. Pretty much simple. Earnings per share, net income divided by number of shares. Book value per share. Now this is tricky. What is book value? Total assets minus outstanding liabilities, which means liabilities other than equities. That is book value. So first, yes, it's net income divided by number of shares. Net income divided by number of shares. So net income we will take from here and number of share we will take from the data sheet. Book value per share, total assets minus liabilities divided by number of shares. PE multiple, a very important metric in terms of relative valuation. Price to earnings. So it is market cap divide by net income. Since both these values are in crores, we don't need to change it. Market cap divided by net income. Price to cash flow market cap divided by CFO, cash flow from operations. Price to sales, again market cap divided by revenue. Price to book value, let's calculate this as price divided by price per share divided by book value per share. Price per share divided by book value per share. Dividend payout ratio, dividend divided by net income, and retention ratio 1 minus dividend payout ratio. Sustainable growth rate, finally, the most important one. This is denoted by small g. ROE, return on equity, into retention ratio. Return on equity into retention ratio. Often in industry, retention ratio is given by B, but you don't have to remember conventions exactly. Different authors refer different conventions in terms of this. Sustainable growth rate, G, retention ratio into ROE. We don't have ROE for this year. So for sustainable growth rate, we will be starting with 2016. Now, track this formula. The main challenge, market cap. Okay, let me check. Oh, yes, 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 yes. Is this only? So please do check, guys. It's price into number of share. This should be the value. Cash flow per share. Has this happened with everything? Oh my God. Okay, no worries. This is good. Okay, I'll repeat the book value part. Just give me a second. I think there is some issue. Okay, market cap, right? This we have corrected. Cash flow per share. If both of the elements are coming from datasheet, let me just check. C, na? C is 16. Okay, and we want B for 15. Okay, C is 16. Okay, control X, control B, control R. This is what we will have to change. Data sheet, data sheet. This is correct. Dividend per share is correct, I guess. Yes. Dividend per share is correct. Again, this is C and D. This we will need to check. Book value per share, C, C, C. This we will have to check. Ratio analysis, C. And historical financial statement, C. Okay, let's do all the other line items together. You guys were done till? You wanted for price to book ratio, right? Price to book value ratio. It's market cap divided by, sorry, price, price divided by book value per share. Price divided by book value per share. Book value per share is equals to assets, total assets minus liabilities sorry, total assets minus liabilities total assets minus liabilities, the whole divided by number of share. Okay. Cash flow per share, cash flow from operating activities divided by number of shares. EBITDA per share, EBITDA divided by number of shares. Dividend per share, dividend divided by number of shares. Yes, it could also be total share in holder equity, but generally the formula, if equity is not given, uh, we will have to take it like assets minus outstanding liabilities. But that formula is what I wanted to incorporate in the session. That's why I included that part. Or else you can directly take total shareholders equity as well. That is also perfectly fine. Because through the basic balance sheet equation, it is assets equals to liability plus equity, right? So that that makes sense. Okay, EPS, earnings per share, net income, profit after tax divided by number of shares, book value per share, I think book value of per share we have corrected it, price to earnings ratio, market cap divided by net income, price to cash flow, B82, perfect. Price to sales, C11 is C column has yes. Price to book value, B90, perfect. Dividend payout, this will be in percentage terms. And similarly, retention ratio will also be in percentage terms. Sustainable growth rate, ROE into retention ratio, this is fine. And yeah, we are done with this. What is the formula for price to earnings ratio? So market cap divided by net income. This is what you can do. Or market price per share, that is price given over here, divided by EPS. You will get the same values. So go with market cap divided by net income. It is, since we have the readily available data in both the cases, we can use any of those. Alt H P. Book value per share, it's is equals to total assets minus sum of what is book value of equity. Basically, assets minus liabilities, the whole divided by number of shares. Close this bracket and you will be having your values. We don't usually say it about price to earnings ratio you're talking about. I am covering price to earnings ratio. Just give me a minute. Sustainable growth rate, ROE into retention ratio. ROE into retention ratio. Retention ratio and above we had ROE. Yes, I have written every formula in the note part. So you will have to go and click on shift on F2. There you will be able to get all the formulas. Price to cash flow. Price to cash flow. Market cap divided by cash flow from operation. Market cap divided by cash flow from operating activities. Yes, I'll share the sheet here as well in the chat box as well. Price to cash flow, market cap divided by CFO. Price to book value ratio, price per share, that is price per share over here, divided by book value per share. So it is price to book value, right? Price per share divided by book value per share. P multiple, market cap divided by net income. Dividend payout ratio, it's dividend divided by net income. Dividend divided by net income. Done. Let me know once done. I have to say something about price to earnings multiple. After this, we only have liquidity ratio. Okay, you guys need a break. Take a break. Take a break for 5 minutes. Shall we get done with the ratio NB and then we can go on a break? We just have three set of ratios. Price to sales. Simply market cap divided by total revenue. Market cap divided by total revenue. Total revenue or total sales. NB, there are just three ratios remaining. Let's cover that and then you can go on a 5 minute break. Although we will be starting with the next topic, that is forecasting. Before that, I will have to give you break because it would be too heavy for you otherwise. Now, what does these ratio indicate? All the per share ratios, all the per share ratios indicate that what is the particular element available to one single shareholder or one unit shareholder. The person who is only holding one single share of the company, what does that person get for being the owner of one single share? So cash flow, he is the owner of 213 rupees per share. When we talk about per share basis, the particular element we calculate and divide among all the number of shares of the company, and we get the per share data. What is the earnings, dividend, EBITDA, cash flow, or book value belongs to the per share or one single shareholder of the company. For price ratio, price multiple ratio, that is PE multiple, price to earnings multiple, price to cash flow multiple, price to sales multiple, or price to book value multiple. Now, these companies, we will see that in relative valuation that we are going to cover after DCF, these ratios will be compared with the peers. So let's suppose there is a company. If this price to earning ratio is 29 rupees, it means that if company is generating 1 rupees earnings, company is charging 29 rupees price from you. If company is generating 1 rupees of cash flow, company is charging 17 rupees of price from you. If company is generating 1 rupees of sales, company is charging 2 rupees of cash from you for being the owner of the company. So this is the price for the company, price multiple that you need to pay to the company to being the owner of it. Now, there is a different company, let's say, which has price to earnings ratio of 15 rupees. That would mean that one company is charging 29 rupees for being 1 rupees of owner. Other company is charging you 15 rupees for being 1 rupees of owner. So this company's valuation is available at a undervalued price, and the company which is charging high is overvalued. But this cannot be just judged based on one single ratio. We need to calculate industry average. Based on that, we can come to the conclusion whether the company's valuation is fairly priced or not. So these set of ratios, the valuation ratios, will extensively be covered under relative valuation part. Finally, we will have set of liquidity ratios, but I think this is your brink. This is the brink of your patience level. You can go on a break. You can go on a break, but you'll be right back. I'm just naming it liquidity ratios. Go on a 5 minutes break, but be right back on time. Sustainable growth rate, retention ratio into ROE. Here we had ROE into retention ratio. We got our sustainable growth rate. Sure, Priyanka, but I don't think you have posed any doubt in between. So did I miss any of your questions? Okay, you are asking from future. Okay, fair enough. Yes, I will be able to address your queries. I will be available to address your queries. In case that if I won't be able to mention those queries in the live class, you will have to raise a ticket and then I'll help you to figure it out. Yes, I can do that. Guys, shall we start? No need of average because both of them are balance sheet ratios. So borrowings upon total assets. Guys, can you listen me? Okay, let's start. Current ratio, quick ratio, and cash ratio. Current ratio, quick ratio, and cash ratio used for short run sustainability, used to assess short run sustainability of the company, whether the company will be able to manage its operations in short run or not. Now, these are called liquidity ratios. Why the word liquidity? Because we need to evaluate whether we need to answer the question through these ratios, whether company will be able to pay off its short term liabilities, whether the company will be able to pay off its short term liabilities. This is what is evaluated by liquidity ratio. How liquid are companies' assets so that they can pay off for short term liabilities. Now, the good thing about these ratios is the denominator is same. Current liabilities will be the denominator for all the liquidity ratios, be it current ratio, be it quick ratio, be it cash ratio. and numerator, the bad thing is numerator keeps on changing. So we need to figure out numerator one by one. For current ratio, the name itself will tell you it's current assets upon current liabilities. Now current liabilities is given by other liabilities. Current assets, when we talk about current assets, what are the things that come under current assets? What are the things that comes under current assets? First, the most illiquid one, let's start with inventory. Second, accounts receivable. Third, marketable securities. Basically what? Short-term investments. And fourth, cash. These are my elements of current assets. When we move from current ratio to from current ratio to cash ratio, we become more conservative. We try to be more conservative. What I mean by conservative, let me tell you a story. There was a person, let's say Anil. Anil owed 5,000 crores of loan. And these loan, basically not only loan, but current liabilities. Anil owed 5,000 rupees of current liabilities that he needs to be paid within 1 year. Anil wants to evaluate whether the current assets that first Anil evaluates that whether we as an analyst want to evaluate whether Anil will be able to pay off his loan or not. So first of all, we will check whether the current assets of Anil are sufficient enough to pay off their loans. So we will be using current ratio. So we will be doing current assets divided by current liabilities. If current assets are divided by current liabilities greater than 1, it means that he will be able to pay off the loan. Now Anil thinks in these current assets, I also have inventory. Now, what if I am not able to sell my inventory? What if I am not able to sell my inventory? Will still I be able to pay off my current liabilities? If yes, then what percentage of current liabilities I would be able to pay off? So for that, we will be analyzing quick ratio, also called as acid test ratio. Quick ratio is current assets excluding the impact of or value of inventory divided by current liabilities. Now Anil says that with quick ratio, we analyze the position of Anil. Now Anil says that in this current asset, along with inventory, I also have some accounts receivable. Now I don't know my customers will pay me back that account receivable or not within 1 year. I don't know whether they will pay me back. So let me evaluate how much cash and short-term investments do I have and what percentage of my current liabilities can be covered through it. For that, we have cash ratio. So formula for cash ratio becomes cash plus short-term investments, the whole divided by current liabilities. Cash and short-term investments, the whole divided by current liabilities. Are you guys clear with current ratio, quick ratio, and cash ratio? Perfect. Let's start putting this in our analysis. So current ratio would be current assets divided by current liabilities. Current liabilities is represented by other liabilities. Current assets divided by current liabilities. Again, coming again, current assets divided by current liabilities. Quick ratio. Quick ratio is all the current assets except inventory divided by current liabilities. And cash ratio, cash and short-term investments, that is cash and bank, divided by current liabilities. This is also represented in times. Now with this, we are done with the thing that I need to add in return on investment. That is, GA mentioned that yesterday. I forgot to address that in the yesterday's class. I told him that I'll add that later. So it is ROIC, return on invested capital. Return on invested capital, that is net operating profit after tax, no PAT, net operating profit after tax divided by total capital, total invested capital, total capital. For current ratio, okay, I'll mention those formula. It's current assets divided by current liabilities. Quick ratio, it's quick assets, that is current assets minus inventory divided by current liabilities. And cash ratio, cash and short-term investments divided by current liabilities. Now, here for ease of doing this, we had directly computed, directly calculated with ignoring the impact of average. Now let's include the impact of average and try to calculate these ratios. Return on capital employed and return on equity, and finally return on invested capital as well. So return on capital employed, EBIT divided by average, open average capital, average capital. So average capital is equity plus reserves plus borrowings for the first year divided by equity plus reserves plus borrowings for the second year. Average of these two will be my return on capital employed. Similarly, return on equity, net divided by, again I will open average, this equity plus reserves, comma, equity plus reserves for both the year, close the bracket. This is return on equity capital. For return on invested capital, I was thinking about mentioning it after free cash flow, but some of you are really curious about it. So let's get done with this as well. So it's profit, sorry, EBIT, EBIT into 1 minus tax rate, EBIT into 1 minus tax, that is no PAT, net operating profit after tax, divided by average of total capital. Again, total capital was this plus this plus this. Why 1 minus, I'll tell you. Comma, this plus this plus this. If you are a beginner, if you are finding it difficult, keep it excluding the effect of average only. No worries, no worry, no need to worry about it. Now, why 1 minus? Good question. Why 1 minus? Try to solve this. If EBT, earning before tax, is equals to 100 and tax is 20%, what is my profit after tax? What is my profit after tax? If earning before tax is 100 and tax rate is 20%, what is profit after tax? 80. Very good. It can also be formulated as EBT into 1 minus tax rate. So EBT is 100 into 1 minus 20%, that is 0.2. 100 into 0.8 gives you 80. So using basic algebra, we can make these formulas. Basically excluding the impact of that 20% that will go to tax, what is the residual value is my profit, and that is what we are calculating. Okay, done. Done, friends. Now, open a new sheet and name that as assumption sheet. The most important sheet of the whole model. Open the new sheet and name that sheet as assumption sheet. Again, I am saying the most important sheet of the whole model. Because we are trying to evaluate the cash flow generating abilities from the core operation of the business. We are trying to generate the cash flow generating ability from core operations. Cash flow can generate it using more and more debt as well. But we are trying to evaluate what is the capacity of business to generate cash using core operations. Take 2 minutes, breathe in and breathe out, and be ready. We are going to start with the most exciting part. First of doing, let me tell you what we are going to do. My screen is visible. My screen is not visible. Give me a second. Now is my screen visible? ROE indicate returns generated by equity shareholders of the company. So if you are the owner of the company and you had invested 100 rupees and generated 20 rupees as profit, 20% is ROE to you. 20% is return on equity to you. Now consider this, what we will be doing. Consider this. We will be making three cases. We will be making three cases: a bull case, a base case, and a bear case. Why do we make these three cases? Because we don't know how, no one can tell you that how is market expected to perform in the coming time. No one can tell you that how is the market expected to perform in coming time. So what can happen? Either the market can perform better as compared to its historical averages. Market can perform as it has performed in their historical times. Market can even perform worse as compared to what it has performed in historical years. Now, see the magic, what is going to happen. When we search for shares, let's say we search for target price of Maruti Suzuki. Target price of Maruti Suzuki. Motilal Oswal says that target price of Maruti Suzuki is 14,700. What Motilal Oswal says? Target price of Maruti Suzuki is 14,700. Okay. Now, there might be another company, another brokerage house, or another investment advisory firm, which may have different valuation for this same company, which may have different valuation for this same company. Just give me a second. Why is this coming? Now, for Prabhudas Leeladhar, the target price is 14,432. For Motilal Oswal, the target price is 14,700. For MK Global, the target price is 10,700. For KR Choksi, private price is 14,975. MK Global revised its private target price to 1,200. So these brokerage houses, every brokerage house gives different target price for the company. Now, how this target price is determined, we are trying to find it. How can we determine that what should be the ideal target price for Motila for this particular company? Now, just a second, give me a second. Let me make a small change to it. Yes. And change this to. Okay. Now, what our analysis says, analysis can differ. My analysis can be differ from your analysis. My assumption about the outlook of India can differ from your assumption. I feel that Indians will be buying more and more cars. You will feel that Indians can shift towards public transportation in the coming years. Every analyst can have their own set of opinions. Being a democratic country, being a liberal nation, we are free to make our own opinions. Based on that, we can come to our own price. Now, why we are making these three cases is because if Maruti Suzuki performs better than the historical averages, how it has performed past, Maruti Suzuki can have a target price of 25,641. If Maruti Suzuki performs better as what it has been performing in the past, it can go to the target price of 25,641. On the other hand, if it continues to perform what it has performed in its past, its target price is around 14,204. Its target price is around 14,204. On the other hand, if Maruti Suzuki is expecting to perform worse, you feel that Maruti Suzuki can't continue to manner which it has grown in the past years, the target price is 6732. So this is what we are going to do. We are going to change our assumption from bull case to base case to bear case, and based on that, we will be getting our DCF value. For that, we are making an assumption sheet. For that, we are making an assumption sheet. Shall we start? Breathe in, breathe out, and then we will start, because this is going to be really exciting. Yeah, it might get heavy, but at least you should enjoy this, Arvind. Proud of yourself that you are doing something which is difficult and not easy, which can't be done by everyone else. It means you would be in a right path towards success. So take your time, take a sip of water, be right back. We will be starting with forecasting part. And let me know if you allow me to start. Let's name this sheet as Alt H MC assumption sheet. Let's name this sheet as assumption sheet of Maruti Suzuki India. Now I want to show you something. Rather than naming assumption sheet over here, rather than naming assumption sheet over here, what I want to make this name dynamic. Now what I want, one option is I am making assumption sheet of Maruti Suzuki. I am making assumption sheet of Maruti Suzuki. I can mention assumption sheet Maruti Suzuki, and that's all. Another thing what I can do is is equals to bracket open sheet now. And what is the difference? Although it appears to be same, but what happens when I will change this Maruti Suzuki India to Tata? Yes. Guys, are you able to hear me? I'm sorry, I'm really sorry. There might be a server issue. So now you are able to hear me, yes? So what I was saying is, although On the first hand, it appears to be same. On the first hand, it appears to be same. What will happen if I make the model dynamic? If I change this to Tata Motors, this will automatically get changed. This will automatically get changed. So try to make your model more dynamic. This is what I wanted to teach you. Okay. You could have you should implement this in retrospect as well. Balance sheet of Maruti Suzuki. How did we make it dynamic? Is equals to bracket open, that is double inverted comma open, assumption sheet space dash space bracket close. Once you are done till here, once you have written this, use and. Why do we write this in bracket? Because if we want Excel to understand the word, we will have to double quote that word, and that is why we are double quoting it. And go to data sheet, write Maruti Suzuki India, click on Maruti Suzuki India and enter. And this is how you will make it dynamic. Okay, fine. Now I have three scenarios. Scenarios. I'm writing scenarios. What I have done, I have just merged it. I've selected three cells, I have merged it. Two cells, I've selected two cells and two or three cells, sorry, three cells. I've selected three cells and I have merged it. I've copied it, Control V, Control V, Control V. Now delete, delete. This will be my scenario one, two, and three. I have three scenarios. I have three scenarios. The first scenario, I am naming the cases. First scenario is a bull case scenario. What would that mean? The interpretation is expectations to perform better than historical averages. Expectations to perform better than historical averages. Base case expectation to perform as per the historical averages. Expectations to perform as per the historical averages. And finally, bear case. A bear market is a falling market where the expectations are to perform worse than worse than the historical averages. Select the whole range, Alt H MC, Alt H OI. Try to do a bit of decoration. Alt H MC, Alt H MC. If you want to color this or give borders, yes, I am making this situation to explain you because my job is not only to make the model but also to make you understand the model with ease, right? So if you don't want to write interpretation, you cannot write interpretation. It's completely your choice. Borders. Let's try to make a border. I want to add borders in between as well. Perfect. Now these are my three cases. These are my three cases. Now, how am I going to do all those borders and those things? By this time, you should, if you have practiced last week, by this time, you should be comfortable doing it. Control 1, go to borders, add borders of your choice. Now, now, here, I have my income statement in front of me. I will copy this whole range, right till dividend. I will use Control C, come to assumption sheet, Alt S, T, Alt S, L, and I will be having with all these values. Some of the values I am getting hash error. I will use Control A and do Alt H O I. Alt H O I. Again, I will do it thrice. I know this is a bit complicated. What I am doing, I have selected the whole range. I have selected the whole range, use Control C, went to assumption, Alt S, L, Alt S, T, and yes, I am here with my values. Delete these zeros in between. If I would have done individually cutting all the line items, this would have not been appeared, but you will have to delete these zeros in between. Again, do you want me to repeat again? Let me repeat this in a rough sheet. Alt WVG. Select this whole range. Copy this. Control C for copy. Go to assumption sheet. This is the demo sheet. Go to home. Paste. Paste special. Formats. Okay. Then again go to paste. Paste special. Values. Click on OK. Values, sorry, not values, but link. Paste special. Link. LLL. Paste link. And yes, if hash errors are coming, Alt H O I. Delete all the zeros that you can see. Also, one thing that you can do is select this. Control H. Find what? Find zeros. Replace with space. sheet by rows, formula looking, formulas, find all, control A, replace all. Okay, it is not coming. So it is, so in that case, you will have to delete it. Once all the values are selected, just delete it. 0% is also getting selected. No, that way we won't be able to do it. We will have to select it. Select and delete it. Alt H Y for what? Now, see, these hash errors might be coming in front of you when you have copied it. To deal with these hash errors, select all, Alt H Y. Done. Done with this, everyone. Now this is what? This is my historical income statement is equals to making it dynamic historical income statement and and historical income statement. From here onwards, we will be making a forecasted income statement. I'm not good with color combination, guys. So please help me out. Yes, let me do that as well. At least the distinction should be pretty much clear. So that's why. Okay. Ideally, you should go with the theme of the company. Maruti's follows blue and red theme. So let me get it done in red color. Let me color it in red color, but a lighter shade of red. Okay. Fair, fair enough. Now I will be doing over here forecasted income statement, historical income statement, and forecasted income statement. Now is equals to last year plus 365 will give me next year value. And I am going to make this model for next 5 years. 25, 26, 27, 28, 29, and 30. These are the years that I need. So for these are years, I will be making the income statement. Alt H MC. So we will stop here for today. I know it's last class for the day and last hour for the day, so it might get troublesome for few of you. I'm sharing the sheet. I hope you enjoyed today's session. But make sure you will practice. If you don't practice, you will not be enjoying. Can you also share yesterday? Yes, we are making model, building the model on the same sheet, right? So the sheet that is being shared today also contains the content for yesterday as well. Yes, I am sharing the sheet. Yeah, the sheet has been shared. Just give me a minute. Yeah, the sheets have been shared. You can check. Whiteboard, whiteboard, whiteboard. Give me a minute. Did we discuss anything on whiteboard? So I'm sorry, AC, but about cash conversion cycle that we discussed on whiteboard, that is not there probably because the network got disconnected in between. You will have to make your own notes for it. So while going through the recordings, you can make your own notes for it. It will hardly take 10 minutes, 10 to 15 minutes. So that was it for the day, guys. I hope you enjoyed the session of asset management on LMS. Asset management notes, I am sure that it have been uploaded on LMS AR. If not, please raise a ticket about it. Thank you, guys. Thanks a lot. It was wonderful having an interactive session with you. See you guys next week. Bye bye. Take care. Have fun.